Welcome to The Explainer. Today, we are tackling a huge topic, fundamental analysis. We're going to show you how to cut through all that market noise and actually make sense of what's going on.
I mean, think about it. Every single day, you're just hit with this storm of financial news, right? You've got oil prices doing one thing, company earnings doing another. It's just this chaotic mix, and it all feels like it's screaming for your attention.
So the big question is, how on earth do you filter all that? Well, the secret isn't trying to react to every little headline. That'll drive you crazy. The key is having a system, a real method for finding the important stuff, the signal in all that noise.
And that system, that's exactly what we're here to give you today. We're going to walk through this really powerful framework called fundamental analysis. You can think of it like a roadmap. We're going to start way up high at the 30,000-foot view, and then we're going to drill all the way down to what's happening inside one single company.
All right, let's get right into it. When you're looking at stocks, there are really two big schools of thought, two totally different ways people try to figure out what's going to happen next. So on one side, you've got fundamental analysis. I love this analogy. It's like being a detective. You're putting on your trench coat, you're grabbing your magnifying glass, and you're digging into the real health of a company, its financials, its industry, the whole economic picture, to figure out what it's truly worth. And then you've got the other side. Technical analysis. This is more like being a chart reader. You're looking purely at price charts and trading volumes, trying to spot patterns and predict what the crowd will do next.
Now, for our purposes today, we are all in on the detective work. We're going to focus completely on fundamental analysis. And the specific method we'll use is something called the top-down approach. It's exactly what it sounds like. We start at the very top with the whole economy and then work our way down.
And this is so important. Before you even think about looking at a specific stock, you've got to get a read on the overall economic weather. Are we heading into a sunny, calm period, or can you see some storm clouds gathering on the horizon? The big picture comes first. So, who's in charge of this weather anyway? Well, analysts keep a close eye on two major players, the government and the central bank. The government uses fiscal policy. Think of it as direct action. They spend money on big projects or they cut taxes. Then you've got the central bank, which uses monetary policy. Their main tool is interest rates. Essentially, you've got one hitting the gas pedal and the other controlling the flow of fuel. And to figure out which way the wind is blowing, they look for clues. These are called leading indicators. They're like the canaries in the coal mine for the economy. Things like how many people are filing for unemployment or how many new homes are getting permits to be built. These numbers can give you a hint about where the economy is headed before it actually gets there. Okay, so let's say you've checked the forecast. You have a good idea of the economic weather. What's next? Well, now you've got to figure out which boats are best built to handle those conditions. And by boats, I mean industries, or what investors call sectors. This is a really cool concept. Just like the economy itself, different industries have their own seasons. They don't all do well at the same time. As the economy goes through its natural cycle of booms and busts, expansion and contraction, different types of industries get their moment to shine. And honestly, it makes a lot of sense when you stop and think about it. When times get tough, say in a recession, what do people keep buying? Food, medicine, the essentials, right? These are called defensive sectors. But what about that new car or the latest giant TV? People tend to put those purchases off. Those are cyclical sectors, and they tend to do great when the economy is humming along. All right, so we've gone from the whole economy down to a specific industry that looks like it's in a good spot. Now it's time to get our hands dirty. We're finally zooming in on a single company to see if it's financially healthy. It's time to pop the hood and look at the engine. And how do we do that? By looking at its report card, its core financial statements. So take a look at these examples from Vodafone. On the left is the income statement. The best way to think about this is like a movie. It shows you the company's performance over a whole year. Then on the right, you've got the balance sheet. This isn't a movie. It's a snapshot, a single photo that says, here's exactly what we own and here's what we owe right now. So where do you start reading? Usually right at the top, with revenue. You'll hear people call it the top line because, well, it's literally the top line on the income statement. This is just the total amount of cash coming in the door from sales before a single bill gets paid. It's the most basic question you can ask. Is the business growing? Now, let's flip over to that snapshot, the balance sheet. Here we're looking at assets. And what are assets? Pretty much everything the company owns that has value.
We're talking about the obvious stuff like cash and factories, but also things you can't touch, like the value of a famous brand name or a patent for a new invention.
Now, here's the thing. Analysts rarely just look at one number in isolation. They're all about creating ratios. So, for example, with Vodafone, you can take their gross profit and divide it by their revenue. That gives you something called the gross profit margin. In this case, it's 33%. What does that even mean? It means for every single dollar they make in sales, after they pay for the direct costs of what they sold, they're left with 33 cents. It's a super quick way to check its core profitability.
Okay, so we've looked at the economy, we've picked an industry, we've dug into a company's financial report card. Why do all this work? Well, this whole entire process is designed to answer one single, massive, multi-billion-dollar question. And that question is, what is this company really worth? See, the core belief here is that a stock's price on any given day might be whatever, but its true underlying value, what they call its intrinsic value, comes from all the cash it's going to make and give back to its owners for the rest of its existence. So you might be thinking, how in the world do you calculate the value of all that future money? Well, believe it or not, there's math for that. You're looking at one of the models right here. And I know, it looks complicated, but the idea behind it is actually pretty simple. All it's doing is taking a guess at all the cash the company will make in the future and then translating all of that back into a single number for what it should be worth today. So let's bring it all home. The big takeaway here is this top-down framework. It's about having a plan. It's not about freaking out over every news headline. It's a logical path that takes you from the chaos and noise of the market to a calm, reasoned decision about what something is actually worth. It's the difference between being an investor and just being a speculator. So there you have it, a powerful framework for turning all that market noise into actual knowledge. It gives you the science part of investing, the numbers, the models, the hard data. But is that the whole story? Because interpreting those numbers, trying to figure out if a CEO is a genius or a fraud, guessing what the world will look like in 10 years, well, that's where the art comes in. This framework won't give you a magic answer, but what it will do is make sure you're asking all the right questions.